How do founders negotiate complex series, A term sheet clauses? Imagine trying to build a house with a blueprint that's full of tricky clauses. Negotiating a series, a term sheet can feel just like that. It's a puzzle where every piece affects your control, ownership, and future growth. When founders step into these negotiations, they need to understand what each clause really means and how it impacts their company. A series, a term sheet, is a non-binding document that outlines the key points of an investment deal. It covers things like how much the company is worth, how much money investors will put in, and what rights they will have. Important parts include liquidation preferences, which decide how proceeds are split when the company sells. Founders want to avoid clauses that give investors too much advantage, like multiple liquidation preferences or participating preferred stock, which can eat into founders' shares. Board composition is another big piece. Investors often want seats on the board, but founders should negotiate to keep enough influence to guide the company's direction. Anti-dilution protections are also common. They protect investors if the company raises money at a lower valuation later. Founders should understand whether these protections are weighted average or full ratchet, and try to negotiate for less harsh terms. Control rights are also key. Investors may want veto power over major decisions like selling the company or raising more money. Founders should limit these rights to avoid losing operational freedom. Valuation is another critical point. If it's too high, investors might hesitate. If it's too low, founders risk giving away too much ownership. Striking the right balance is essential. Preparation is vital. Founders should gather all business documents, like financial statements, legal agreements, and intellectual property records. Consulting experienced legal counsel who specializes in venture capital deals can help spot clauses that could harm the company later. During negotiations, it's important to know what's non-negotiable and stand firm on those points. But it's equally important to avoid endless back and forth on minor details so the process stays efficient. Building good relationships with investors during this process can pay off. Showing professionalism, transparency, and a clear strategy helps create trust. Understanding what investors want, such as scalability, exit potential, and protections, can help founders align their goals and negotiate terms that work for both sides. In the end, negotiating complex Series A clauses is about understanding the terms, prioritizing what matters most, being well prepared, and communicating clearly. This approach helps founders protect their ownership, maintain control, and secure the funding needed to grow their company.